Hi, Advanced Accounting. So in this video, we are going to go over an entire consolidation problem for 2 years. So I'm going to try to make it as quickly as I can, but please bear with me. Okay, so here's the problem. Chapman Company obtains 100% of Abernathy Company stock on January 1st, 2020. So they own 100%. So this particular problem, it says, I want you to look at where it says, assume that Chapman Company acquired Abernathy's common stock for $500,000 in cash. Assume that the equipment and long-term liabilities had a fair value of $220 and $120 respectively on the acquisition date. Chapman uses the initial value method to account for its investment. We got to remember that later on. Prepare consolidation worksheet entries for December 31st, 2020 and December 31st, 2021. We're going to have to remember we made entries for 2021 for certain accounts. All right, so here's how I did it. The first thing I went through and I analyzed only the net assets. So I'm looking at this particular problem. It has accounts payable, a $50,000 credit. All right, I showed accounts payable. Accounts receivable, $40,000, debit. Additional paid in capital, no, I won't include that. I'm coming up with net assets. That's an equity account. Buildings, 4-year remaining life. I'm going to use that later on, 120. Cash and investments, 60. You get the point. So I'm going to equipment. Notice I crossed off my original value. It's now 220. Next I list inventory, land, long-term liabilities. I crossed off the original 150. I changed that to 120. I've got supplies, and then I total down. I add my positives and negatives. My net assets are 450. Next, I'm going to figure out my goodwill. So I take 500 minus 450, and that gives me $50,000 for goodwill. Okay? All right, so over to the board, I am going to show you this analysis. Get in the habit of doing this analysis. I have implied fair value, parent price. This is not in your textbook. Do this when you do these problems because they get more complicated when it's non-controlling interest. Then I have non-controlling interest. Okay, so then I have purchase price. I just input my number. They own 100%. That is 500,000. Whoops. The parent price is the same because they own 100%. Non-controlling interest is 0. Next, I figure out the stock equity. So I'm going to get only my equity accounts. I go back to my sheet that I was given for this problem. I total up my additional paid in capital, 50. I total up my common stock, 250, that's 300. And then I total my retained earnings, and that is 100. So stockholders' equity is 400,000. I subtract that, and that gives me my excess price over book value, and that is 100,000. Everybody listening, that's your check. I better get 100,000 down here as well. All right, so now I'm going to do my excess price. Actually, no, it has the adjustments. This is, you can just do this in your notebook. So know this as adjustments. I think it's easier. All right. You're now going to adjust for the difference between fair market value and book value. Let me stop. Students, rightfully so. You've learned an entire purchase where the other company is going away. You make the entry for the entire amount, not for this one. This is a consolidation, so you're going to have a parent and a sub. The other company is not going away. All right, so you're only going to make a different entry for the difference. So I analyze the equipment, the fair market value, from the book value, the difference is $20,000. I put in equipment, 20,000. That's a debit, right? Kind of write a note to yourself, debit. Next, I go to long-term liabilities. And that is 30,000. However, that's a debit. Be careful on that. That went down. Show that as a debit. So the difference between the fair market value and the book value was 30,000. It went down. All right. Say you stopped, right? This is your check. Say you went 20 plus 30. Well, that's only 50. You have to equal 100. That's how you could have caught, oh, I missed goodwill. So here's goodwill. And that is 50,000. That's also a debit. Just kind of tell yourself what you're going to do and total that. All right, now we're going to do additions. Here's why. We're going to do all the entries. So I want to keep track of this. So the 20,000, we have to figure out depreciation only for that difference. So I go back to the problem. What did they say the equipment would last? They said 5 years. So I'm going to take that 20 straight line depreciation. I'm going to divide it by 5 years. Okay, and that equals 4,000. All right, next, long-term liabilities. They didn't make this one clear, so let me show you how you're going to do that. Long-term liabilities, we purchased this other company on January 1st, 2020. When they did, they have a long-term liabilities. They don't mature until 2023. Just assume these long-term liabilities are bonds, okay? All right, so 2020 I will count, 2021, 2022, 2023. So that's 4 years. That's how you come up with those 4 years. Then you divide it by 4. And that will equal 7,500. Okay, those are dollar. All right, and then total those because we're going to do entries for these later on. All right, but that totals 11,500. Okay, that you're not going to do in the lab. However, please do that before you start working on these journal entries, or I promise you, you're going to get very frustrated. All right, so now I'm going to erase. We have this analysis. Now we're going to get to the entries. Okay, erase. All right, so go over here. All right, now I'm getting to my entries, which are right here. All right, so we've got 2020. 2020. Okay. This is 12/31/2020. I've got debit and I've got credit. Okay. My first entry, this is entry S. I'm going to eliminate my equity of the sub only. So I go common stock. No wonder why they don't put in additional. I'll put the debits and credits in a minute. Additional paid in capital. And then I have retained earnings. This is 1/1/20. Okay? All right, so we got common stock, 250. We've got additional paid in capital, 50. We've got retained earnings, 100. And then we credit the investment account. Total that totals 400,000. What's the reason? We're going to eliminate stock equity for sub. Okay? Next entry, we have entry A. That's going to be your adjustments. I'm going to debit equipment. Here, this is debit. This is credit. I'm going to debit equipment 20,000. Debit long-term liabilities 30,000. Debit goodwill. Remember, that's the 50. And then credit the investment account. Now watch this. These two must always equal your purchase price. 400 plus 100, it equals the purchase price. Now I'm going to do entry I. All right, let me explain to you what's happening. All right, this is the initial value method. I know it as the cost method, so I'm going a little crazy on this because this textbook calls it the initial value method. All right, it's the same as the cost method. Okay, so you're going to eliminate what you did at the lower level. So when it's the initial value method, the only adjustment you adjusted for was dividends. Our original entry was we debited dividends declared and we credited dividend income. Another textbook might say debit dividend receivable, credit dividend revenue. The bottom line is that dividend affected the income statement, remember that, but we're going to take that back out. So entry I, we're going to eliminate our entry, we're just going to reverse it. So now we're going to debit dividend income, and that is $10,000. And then we're going to credit dividends declared. Also 10,000. Just tell yourself what you're doing. You're eliminating the intracompany dividend. Okay. Oops. Dividend. Okay. All right. Now we're on entry I. Entry E. Entry E. Go back to our original analysis when we did those, we figured out depreciation, we figured out interest expense, okay? So the interest expense is going to be the $7,500. The depreciation is going to be the $4,000. That related to a bond. So we debit depreciation expense. For 4,500. No, I'm sorry, 4,000. And we credit interest expense. We debit depreciation expense, 4,000. We credit interest expense. Did I just say credit? I'm getting tired, everybody. Debit interest expense, 7,500. Credit equipment, and I'm not done yet. Credit equipment, 4,000. And credit long-term liabilities, for 7,500. Okay? All right, let me draw a line. Look at the equipment. It was 20. I just made an credit to equipment. I need to account that when I go to 2021. Look at my long-term liability. I debited that. It went down. But now I'm crediting for this additional interest expense. don't forget to do that. So now I need to net that. I'll explain that when we get to that entry. All right, we're going to start with 12/31/2021. All right, you're going to have a different entry. Now you're going to have entry C. We didn't have entry C before, but the reason being is entry C is associated with beginning retained earnings. So we now have to convert to the equity method. Remember how to do this. We did a problem prior to this. Okay. So the net income was $80,000. When it's the initial value method, I don't adjust for net income. So I need to adjust for it now, $80,000. When it's the initial value method, yes, I adjusted for those dividends. So I need to take that into account. I will only recognize net income for $70,000. Remember that. And then I'm going to adjust for the interest expense and the depreciation. That is $11,500. So when I net those, let me write that over here. All right, so we got 80,000 minus 10 minus 11,500. And that equals net income of 58,500. That is my entry C for 58,500. That's how you get that number. Now, if it was the equity method, I wouldn't have to do it. If it was the partial equity method, I would only have to adjust I'd only have to adjust for the 11,500 because the partial equity adjusts for the net income, all right? And I wouldn't have this 10,000. That's the I can't think of the name of it's called. I know what is the cost method. What's it called? It's called the initial value method. All right. Okay, so we're going to go over. We've got debit. We've got credit. Now we're going to do entry C. We didn't have entry C in 2020 because it just started out. They didn't have beginning retained earnings. So I debit investment in Abernethy, 58,500. I'll put the debit and credit in after. And then credit retained earnings. Put the date 1/1/21, 58,500. Okay? All right, now I'm going to do entry S. It's going to be very similar as 2020, although one difference. All right, so entry S. I've got common stock. Let me kind of draw a line. I've got common stock. For $250. Additional paid in capital. $50,000. Then I have retained earnings. Okay, retained earnings. This is for 1/1/21. Okay, all right, now you're going to make the entry for the depreciation and interest expense separately. So the adjustment that I will make is for that 70,000. Okay, so it was 100,000. I am going to debit retained earnings for 170. That's the 80,000 minus the 10. And then I have investment credit, investment in Abernethy, 470. Okay, so total that up, 470. Okay. Now I have entry A. Okay, everybody listening? My equipment is now different. It was 20,000, but I made an adjustment for 4. So my equipment is now only 16,000. My long-term liabilities. It was 30,000, but I made an adjustment. I credited that account for 7,500. So now that 30,000 is brought down to 22,500. I'm going to adjust for goodwill. That's the same. $50,000. And then I adjustment investment in Abernathy is 88,500. Okay? All right. Next, I have, here's the good news. I'm going to draw a line. My dividend income is now 30, but it's those exact same accounts. So dividend, and this is entry I. So I have debit dividend income, but the dividends change, so be careful of that. Read the problem. Sometimes they make them the same to make our lives easier, but this one they changed. They changed it to 30,000. Okay, so that's dividend income. And then dividends declared. Okay. All right, and then I come to entry E. All I'm going to write, exact same as 2020. Exact same as 2020. Okay? All right, I know that was a long one. This is a master's class. You're getting into 2 years now. When I teach an undergrad, I only do 1 year. Masters, you want to see what happens with that second year. So you saw some of those changes. Some of the accounts were exactly the same. Make sure you know the accounts that changed. All right, I'll see you soon. Get into the lab and get that homework done.